Good morning, everyone. Carl here from ThinkMarkets with your weekly market analysis session. This is where we recap all of the key events from last week and have a look to the week ahead, kicking off with crypto markets, and looks pretty good there if you look at the 1 week gains. And to be fair, that's what happened last week, but over the weekend, as tends to be the case in crypto, we do get some volatility, this time to the downside. So most of those prices probably down about 4 or 5% since that update. Still down for the month. Pretty much across the board, there's just Solana eking out a gain, and then you can see the damage that's been done for the year. We are still at extreme fear in crypto markets, thanks to Alternative Me there. Having a look at the Bitcoin chart, trend is your friend, unfortunately, if you're a Bitcoin enthusiast like myself. Short-term trend, that's a light pink zone, well established to the downside, and that last little candle there, that Sunday's candle, has extended further to the downside. It's a slightly longer black candle. Long-term trend still down. That's the key story there. Key supply zones 22,960, 25,366. I could not even contemplate getting excited about the possibility of a rally until we're trading at least above the lesser of those two zones, but preferably above the higher of them. If we see this black candle get some friends, as in today and tomorrow's candle, then we could come back and test that 17,585, and I think there's a 13,860 off the top of my head beneath there as well. Having a look at Ethereum, not much better, so we'll just go ditto on this one. That 1280 level appears to be well entrenched as supply demand coming in around about that 880 level, and if we get beneath that, there's not a whole lot holding Ethereum up. Clear long-term downtrend to boot. Having a look at stocks now around the region here in Asia, Nikkei up 2.2%, but falls in Shanghai and in Hong Kong. US markets, they were the ones that lit the world up last week, up 5.5% there on the NASDAQ. Big risk on tech focused move, but the S&P 500, not a small move at all, up 3%. The Dow Jones up 2%. That's that more sort of defensive value sector. So you can see that big skew towards risk on, and volatility down 14% demonstrates that as well. We can see now we've had really sort of three solid weeks to the downside on volatility. European stocks slightly higher. Having a look at the S&P 500, that key benchmark index from the US, picture tells 1,000 words. You know, we are in this bear trend, I believe still, that long-term dark pink zone still heading down. The short-term trend ribbon here, very good at telling us where rallies have ended in the past, and we're in that zone now. The good news for investors, however, I think these are really strong candles here. 1, 2, 3, very strong off 37, 38. That trough there higher than 36, 36, encouraging, showing a bit of buy the dip coming back into markets. And we've hit the zone with some white candles. That's pretty good because we've tended to lob in some black candles when we get there in the past. Hey, still might be the case. Let's see how we go this week. But hey, if we can print a bunch of white candles this week, that's very positive for a move through 39.46, taking out that last peak and therefore putting us back into this sort of higher peaks, higher troughs move again, indicating, you know, buy the dip, reinforcing demand, supply removal. 41.78 is probably that next key level to the upside. And look, you know, plenty of water needs to pass under the bridge before we get there. Having a look at the NASDAQ now, again, a pretty encouraging sign there. Those last two candles, you can see white. Hey, we've had 4 or 5 decent ones in a row now of 10.850. That's higher than 10.565. So again, if we can close above 11.678, we're going to go back into that higher peaks, high troughs. And that's that really minimum requirement there for even contemplating that the bearish trend is turning around. We call that demand reinforcing price action. Long-term trend is still down, so not going to get too excited until we get above, at least I'd suggest, 12.320. Having a look at some of the commodity moves now, and this is again that proxy for world growth, fears increasing that we could find ourselves in a recession in many of those key global economies, including the US, including in Europe. Copper, that's the important one, Dr. Copper they call it, down 3.2% there on the London Metals Exchange, and just under 3% there on the high-grade copper on COMEX. Having a look at some of the other sort of key moves there, IronOre, we know that's an important industrial metal, down. Just a quick look over here at the IronOre chart, you can see holding 106, but the trend very well established to the downside. Bit of a broken record here for me today on that. So not getting too excited until we're back above 125, but that does seem miles away. More likely, we're probably going to crack through 106 and then see 80 460, or at least a move down towards that zone. Copper looks even worse. I mean, it has cracked already, hasn't it? So, clear breaking of that long-term uptrend, moving now, confirming the long-term downtrend 97.12, and then it was a very slippery slope from there, taking out another key level here from December 2020 at 7741, and a pretty feeble low, I would suggest, so far at 75.25. So trends very well. It's got to the downside there, and then nickel as well, looking pretty similar, and we have given up more than our Russia invasion of Ukraine gains. Gold, this one has been holding pretty steady up till now, but also cracking during the week. And now with a pretty decisive break, I'd say, of that sort of 1780 zone that was holding pretty well. 1720 and maybe 1684 is the ultimate goal here. Having a look at the energy prices now, pretty good end to the week for crude oil. You can see the chart on screen, Thursday, Friday, popping back up from that long-term uptrend zone. No reason why it can't hold that long-term uptrend zone, dark green zone. It certainly held it really well in the past there, 61.74, 62.43, a little bit of a reinforcement here. So, every chance this test holds, we could see 108, at minimum to the upside. That's that light pink zone now potentially acting as supply. Watch for black candles in there. That would indicate a continuation of the trend, and then a really serious test of that long-term zone. Otherwise, if there's a bit of an overshoot, I'm thinking 114, 116, let's call it 115 midpoint there as the next key supply point. You can see oil was down net for the week, as was Brent. Natural gas, however, getting a little bit of a bounce, but you can see how much it's pulled back for the month. The Aussie dollar having a little bit of a rally amidst a much stronger US dollar index, and bond yields heading back up on some pretty bullish US data. We'll talk about that in a sec. Australian bond yields still hovering around that 3.5% level, but well off those highs there at about 4.1%. And I think shaping up based upon some of these candles in that zone to move a little bit low on those rates. Not the case in the US. 3 strong candles there to close the end of the week. Now, when I say strong candles, of course, that's rising yields, which is falling bond prices. RBA interest rate decision during the week, they did go another 50 basis points higher, and that comes on the back of the 25 basis points in May and the 50 basis points in June. We're now sitting at 1.35% on the cash rate. Reserve Bank said that they are simply withdrawing the extraordinary monetary support that's been in place since the COVID pandemic began. They are going to continue to take steps to ensure inflation returns to target over time. We should be prepared for more interest rate increases. Incidentally, the average mortgage over here in Australia has gone up around about $665 a month based upon those rate increases since April. And with more to come, that number no doubt going to increase. Economists, depending on who you listen to during the week, I saw a few estimates there expecting the local house prices to drop anywhere between 10 and 15% over the next 12 months or so. Market is now pricing a 97% chance of a 40 basis point hike to 1.75% at their next meeting on August 2nd. Interesting, market sort of looking 40 basis points now to get to the quote-unquote round-ish number of 1.75%, because the RBA tends to move in 25 basis point increments. So that would sort of get us to like a double zero on the next one, and then 2.25, 2.5% potentially from there. Having a look at data out of China, very important. Inflation data is all important at the moment. We did get the consumer price index, that's the CPI, came in at 2.5% year on year, which is actually pretty moderate compared to a lot of the other developed economies, but hotter than expected. Market was expecting 2.1, and it was 2.1 previously. So you can see the trend is high here. And that's because, the wholesale inflation tends to lead the consumer inflation. That's the one over here with the producer price index. And you can see the mountain that it's climbed, and that's probably what the CPI is doing. But the good news is that the PPI is on the way back down, despite continued impacts on the supply chain there due to their COVID restrictions that are still very much in place. So 6.1% year on year. That was a little bit hotter than the 6% expected, but not a whole lot, and certainly still trending down from the previous. Having a look at the FOMC minutes out last week. This was for the June meeting. Sorry, scratch that. There's a bit of a typo there. June meeting 14-15, quite certain from last month, but it has come out this month, hasn't it, of course. They suggested that an even more restrictive stance could be appropriate if elevated inflation pressures were to persist, and they look like persisting. Participants judged that an increase of 50 or 75 basis points would likely be appropriate for their next meeting. Now, that is, of course, on the back of the 75 basis points they did at the last meeting, which is on the back of the 50 and then the 25 and the two meetings beneath that. The committee is still seeing a significant risk that inflation is going to remain elevated, but it could become entrenched. And that is the key issue, isn't it? If inflation expectations become entrenched, we're going to get more of it. So the FOMC not wanting their resolve to be challenged there. They want the public to know they are absolutely set on getting inflation under control. They did increase their PCE index estimate from 4.3% to 5.2%, which is still lagging the actual number of 6.3% in May. The dot plot's very interesting. We can see by the end of 2022, we should expect an interest rate pretty close to 3.5%. So roughly double the 1.75% we've got at the moment. Interest rates potentially peaking by the end of 2023, around that 3.75%, and then coming down from there as I guess that the hard work on fighting those entrenched inflation expectations has been done, potentially undoing some of the damage done to the US economy. Having a look at the employment data out during the week, 372,000 jobs seems like a pretty hot number compared to the 200,000 estimate. Maybe that estimate was a bit low because it's not too different from the previous months, but we did see about 70-odd thousand jobs knocked off, revised down, I should say, off the previous months, took some of the shine off that number. Also taking some shine off was the lower participation rate at about 62.2%, down 0.1% from previous, again saying that, look, the employment market is strong in the US, but there's still a bunch of people just sitting on the sidelines, not feeling confident enough to go out there and seek a job. The rate at 3.6% was unchanged. Having a look at some Australian data now for the local market here. The S&P ASX 200 up 2%, pretty solid week overall, to be fair, and just the material sector missing out. But it is a pretty big miss, given that it is such an important part of our overall index, and definitely reflecting those weaker commodity prices in general, and this expectation that it is an expectation now. I think most analysts would suggest that it's more than 50% in terms of the chance of having a recession, 2 consecutive quarters of negative growth, probably in the US and more likely in Europe. Standouts, information technology following that NASDAQ up about 7%, and discretionary sector, another one of those hard hit sectors by rising interest rates, rising inflation, major dents into disposable income, but bouncing back in that risk on skew to the rally. But staples, having said that, also doing pretty well, another one of those defensive sectors, and healthcare, shouldn't forget to put that one in, up 5%, another defensive sector doing well. So this market caught in two minds is one way to put it, between, well, are we going risk on or are we going defensive? So there's still plenty of uncertainty there, and that's evidenced by very strong trend, I think, still to the downside here, that light pink zone. Can't get too excited until we're closing, a few solid closes, white candles above 67, 64 to tell us that supply, a pesky supply that's been nagging the markets out of the system, confirming these high peaks and high troughs that we're starting to move back into. 69.30, maybe you'd almost say we're out of the woods by then, but that long-term trend still entrenched. So the candles are key here. Watch for the color of the candles, the direction of the shadows. Black candles in this zone, upper shadows, we're coming back down again. White candles in this zone, lower shadows, and we've got a really good chance to push higher. Having a look at some of those key metrics for the local market, first up with the ASX 300 technical analysis market breadth. So what we're doing here is measuring the number of stocks in the ASX 300, so going broader than the 200 benchmark, and seeing how many of the stocks are in their respective uptrends over these various timeframes. If 5 periods is 1 week, 10 periods is 2 weeks, then we've got a month, 2 months, 3 months, 6 months, out to around about a year. And we can see improvement through the week. That's the orange line. The yellow line is the previous week. So substantial improvement in that short-term trend for, I'm going to say, the majority of stocks now, up to about 2 weeks, trending higher than their 2-week trends. We can still see the vast majority of stocks are still well below their long-term trend. So we do need to see this broaden out to continue to be encouraged by the underlying performance of those Australian stocks. And you can see actually on the 5-week trend, we're actually up into bull market territory. So that's an encouraging sign also. Somewhat encouraging is that some of these colours on our traffic light system model here for sector trends are changing. Discretionary going from down to neutral. That's encouraging on that rally last week, as did technology. Now, technology has been almost exclusively red for about 18 months. So maybe the inklings of a bit of reversal there. Healthcare has been bobbing up and down, to be fair, but managed to get itself back to up. Long-term trends still down. Staples backed up with that strong move last week as well. And the ones that have been doing so well, really, whilst risk off has been in place, your energy sector, your materials and utilities. Now those trends have turned, so you can see some switching there in the market. But the overall trend for the ASX 200 is still down in my opinion. Have a look at some of the value-based metrics here. We'll just maybe focus on some of those moving sectors. So the discretionary sector actually starting to look a little bit cheap compared to its pre-COVID average, certainly down from its 30 peak since COVID, when we're all getting excited about those consumer stocks because of all the spending that was going on. You can see how much that's turned around. So they are getting closer to cheap. Energy still looks cheap, materials still looks cheap, but we're cycling the bump in commodity prices there. So just be careful. We talk of this value trap where potentially PEs are cheaper than they should be because the E's are expected to come down and compensate for those low P's, if you get what I mean. Rewind that, play it a few times back. Staples, maybe not as cheap as your discretionary there after last week, and technology, that's the one we have to talk about. Still looking pretty expensive, I would suggest, against their pre-COVID averages, but maybe there is a post-COVID new norm there. They're certainly well down from their 77 high post-COVID. Having a look at the week coming up, we do have some consumer sentiment, business confidence surveys coming out tomorrow, and then the big one, the employment change, coming out on Thursday. Looking abroad, a big data week for China. We call it the data dump, the M2 money supply, new loans. Then looking down the list, we're going to get retail sales, fixed asset investment, industrial production, and unemployment rate as well. Big week also in the US. Inflation data is absolutely massive at the moment, so super hot print coming up on Wednesday for CPI. Markets are expecting 1.1% on the month-on-month change, a little bit hotter than the previous month there. The quarter coming at 0.6%. PPI also this week, so double whammy there, 0.8% on that one. That's headline, and then 0.5% on the core. Then we're going to get a US retail sales and consumer sentiment survey, and again, super important at the moment because we want to see what impact these interest rate increases and Fed messaging is having on spending. 2/3 of the US economy is consumer spending, and then that sentiment as well to get some forward indication on how consumers are feeling. I'll be back tomorrow for Ask the Experts, as we get to hang out with me for an hour and talk about your portfolio. I'll give you a quick technical and fundamental reader on those stocks, or you could ask me about crypto or indices or commodities, anything you like. So hit to the website there. There's the link. Make sure you register, and I'll catch you at 1 p.m. Sydney time. Apart from that, if you are not a client of ThinkMarkets yet, you certainly should be. We are the good guys in the Australian broking market. We have all the products you need to trade at a fantastic rate. It is CHESS sponsored as well. Make sure you're dealing with a broker who has your CHESS sponsorship in place. They're not getting aggregated with a bunch of other investors on your trades. 24/7 customer support, world-class trading app. Head to the website, register for an account. You could be trading in minutes. If you're watching me on any of the socials, make sure you hit the respective subscribe buttons to remain notified of any new videos we produce. And please smash the like button to let us know you love what we're doing, so we'll continue to do it. Apart from that, it has been a pleasure chatting with you this morning. Hopefully I've brought you up to speed on everything you need to know. All the best for your investing. Until we catch up again, bye-bye for now.